Let's start off with auctions coming out of the Debt Management Office. It was the 5-year paper on auction at 11.19% and the 7-year at 11.4%. Were you surprised at these rates?
Well, not really, even though that auction did happen just before the federal allocation was released on Friday last week. It happened on Wednesday. I think what was interesting, though, was not the absolute rates, but the spread. So in the previous July auction, we had seen the 7-year price at 79 basis points over the 5-year. Now it came in at 20 basis points, more or less. So those spreads have narrowed, but the overall rate was, I think, expected.
Those spreads have narrowed, and this refers to just some editorials coming out of Nigeria, for instance, where pension funds have seen better value in fixed income. But looking at the 2014 paper, for instance, where the yields were 10.5%, there is a view that we're starting to see them declining. They're saying year to date something like 186 basis points. How stable are these yields going forward?
Well, you have a bit more volatility on the short end of the curve, because a lot of that money that is going into those shorter dated securities are competing with T-bills. So there was some volatility in T-bill rates last week, and that is what you see at in the 1- and 3-year bond areas. But the rates have improved significantly. I mean, the yields have trended down. Prices have gone up since June, when the foreign investor rules were changed. But we are seeing that start to unwind slowly.
Going forward, what are you expecting to see in the month of September? Because we're going to be seeing a return of state and corporate bonds. Are these markets going to be active?
Yes, I mean, so far this year, it's not been so active in terms of closing deals. Probably 8 billion corporate, 13 states, and we are going into September. But one thing to bear in mind is because of the rules with the SEC that say your accounts go stale after 9 months for corporates and 12 for states. A number of people will have to close in September, and some will have to close by December. So September has quite a bit in the pipeline. Probably close to 100 billion of state bonds are expected to close in September, and about half as much as that of corporates. So this should be where things turn around. And historically, from September to December is where most of the activity is, because of the accounting validity issues.
All right, now, those who've been looking at this market say that there's been a flight from equities. Definitely, we're seeing that in the numbers, and that it's been a flight to fixed income. But past the 30th of September deadline for the banks, and hopefully some normality being restored into the index, people might see a return back to equities. How do you see trends going forward?
Well, I think, I mean, in terms of the equity market, things have not been so good. Probably year to date is below -10. Again, it's all about news coming into the market. There's not a lot of news between now and September ending. And so if we see very good Q3 results coming out probably later in October, then you could see an improvement in those indices. But you need to see some real good news. And I'm not sure that the banking deadline is enough good news to move this market.
So basically you're saying investors will hold their positions on the fixed income side?
Well, fixed income has been where most of the action has been this year, and there's not very much reason to think that's about to change. I mean, if you're in fixed income, you're probably up more than 10% year to date, instead of being -10 on equities. So that is probably going to remain till closer to the end of the year.
Indications coming through from the new economic cluster, the new economic grouping within government. We heard Dr. Ngozi Okonjo-Iweala outlining some sort of a blueprint. A key priority for her is macroeconomic stability and trying to rein in government spending and keep the deficit at its worst at 3%. That should bode well for government securities. But do you think they're going to achieve some of these aims?
Well, I think, I mean, there are two ways they can get to that 3%. One is to actually cut government expenditure and hence cut the deficit. The other is to grow the economy. From what we've seen so far, the rates of cuts are not radical enough to expect to see a dramatic drop-off in debt issues. So if you look at this year compared to last, DMO auctions are probably, they're probably almost the same as last year, maybe 5% different. So it's unlikely you'll see a massive drop-off in debt issues, but if the economy does grow faster than the current 6.8, to something closer to 10, then they could achieve those numbers without very dramatic cuts in government expenditure.